Okay, let's get into it. We're doing a deep dive today, looking at a stack of research on uh, a pretty provocative housing idea.
Yeah, one that's been getting a lot of airtime lately.
It's the 50-year mortgage. It's popped up in, well, everywhere, from home builder announcements to political tweets.
It really has. It's pitched as this ultimate affordability solution. We saw former President Trump mention it, and, big developers like P.O.'s jumped right on it.
Calling it a game changer.
Exactly. A game changer that's supposed to fix the housing crisis.
Right. So our mission here is to really scrutinize that claim. We want to move past just the idea and look at the actual numbers.
The math that's presented in the research we've gathered.
Yeah, the hard mathematical truth. Is nearly doubling the standard loan term a real solution, or is it, like the analysis suggests, potentially a structural mess?
Well, the sources we looked at argue pretty strongly that the math just doesn't add up.
Okay.
They basically say doubling the term gives you almost no real benefit, but introduces some pretty significant systemic risks.
Let's start with the basics then. Why 30 years in the first place? That term is, it's dominant. Over 90% of buyers go for a 30-year fixed.
Yeah.
How did that become the standard?
It actually goes back quite a way, mid-century history, really.
Oh, interesting.
Yeah, the 30-year fixed loan became standardized around the 1940s, maybe early 50s. It was mainly to help finance that huge post-World War II housing boom.
Ah, okay. To build homes, get people into them.
Exactly. Offer long-term stability, let families build equity over, a generation.
And that stability, that's the big selling point, right? Fixed rate, fixed payment. But the way these loans work, especially early on, it can be kind of brutal.
You're talking about front-loaded interest.
Yeah. Walk us through that mechanic.
Okay, it's pretty straightforward, but the impact is huge. Every single fixed monthly payment you make gets split. Part goes to principal that's paying down the actual loan amount.
Right.
And the other part goes to interest, the bank's profit, basically the cost of borrowing. But because your loan balance is highest right at the start, almost all of your payment for the first decade, it's just interest. Very, very little actually chips away at the principal balance.
And there's the stat in the research, it always gets me. The average person only owns their home for about 12.3 years.
That's right.
So what does that mean for their principal payoff on a standard 30-year loan after 12 years?
It means they've barely made a dent. Seriously, you've essentially spent over a decade mostly just paying the bank's interest.
Not building much equity then?
Not significant equity, no. The research even had this example, a $600,000 home bought 30 years ago. If you held it the full term, your total payments would be like $1.2 million.
Wow, double the price, all in interest.
Pretty much.
So, okay, understanding that front loading, that's why people might logically think, well, longer term, lower payment, let's go to 50 years.
Exactly. They assume the benefit you get going from, say, 15 years to 30 years.
Which is significant.
Very significant. They assume that same kind of benefit applies when you stretch it from 30 to 50.
And the research says that assumption is flawed.
That's the core mathematical mistake, according to these sources. The benefit isn't linear at all. Once you go past 30 years, you hit this point of seriously diminishing returns.
Okay, let's break that down. First, let's establish the 15 versus 30 comparison. Why is that jump so appealing? Let's use the example they gave. $500,000 home, 20% down, maybe 6% interest.
Okay, so on a 15-year term, your payment's pretty steep, about $3,300 a month.
Right? You're a good income for that.
Yeah, you'd need roughly $10,000 a month in income just to qualify. But switch that same loan to a 30-year term.
And the payment drops.
Dramatically, down to around $2,400 a month. Now you only need about $7,500 a monthly income.
That's a huge difference in accessibility.
It is. And here's the kicker, that lower payment means you can actually qualify to buy a house that's 34% more expensive.
34%. So instead of a $500K house, you could potentially afford something closer to $670K?
Exactly. That huge jump in purchasing power is why the 30-year mortgage became so dominant. It makes a massive difference.
Okay, so that's the benchmark now, the 30 to 50-year jump. This is where the sources say the math falls apart.
Completely. The numbers are actually shocking when you compare them. Extending the term from 30 years all the way out to 50 years, it improves your affordability by less than 8%.
Less than 8 compared to 34.
Correct. You're nearly doubling the time you're in debt for less than a quarter of the benefit you got from that first jump.
Wow. Okay, but hang on, let me play devil's advocate. Even if it's small, maybe $300, $400 a month saving?
Right, the theoretical saving if rates stayed the same.
Yeah, if I'm desperate to buy, isn't any saving helpful? Why do the sources call even that small theoretical gain a trap?
Because that best case scenario, maybe saving $368 a month in their example, it relies on something impossible. The interest rate staying the same.
Ah, okay. Lenders charge more for longer loans.
Absolutely. Their capital is tied up for much longer, which means more risk for them. So, a 15-year loan might have the lowest rate, say 5.375%. A 30-year might be 6.125%. But a 50-year loan, the realistic projection puts it closer to 7%, maybe even higher.
Okay, so that rate hike could wipe out any savings. Or worse.
Much worse, usually. Yeah. Let's run those realistic numbers again on that same $500,000 loan example.
Okay.
30 years at 6% interest, your payment is about $3,000 a month.
Got it.
Now factor in the likely rate hike for the longer term. 50 years at 7% interest, your payment jumps to $3,800 a month.
Wait, it goes up by $800.
Yes. You end up paying significantly more each month for a loan that takes an extra 20 years to pay off.
So the whole affordability argument just evaporates.
It completely reverses, actually. The supposed solution makes housing less affordable on a monthly basis in realistic scenarios.
Okay, affordability is out. What about the other risks? The sources talked about equity risk for the borrower because of that extreme front-loading on a 50-year term.
Yeah, it gets much worse. When do you actually start making real progress paying down the house? Much, much later.
Yeah.
Take their example. A $550,000 home, maybe 10% down, on a 50-year loan. If you sell after 12 years, remember, that's the average holding time.
Right.
You would have paid off only about $32,000 in principal.
$32,000. After 12 years of payments.
That's it.
So if you sell and you have closing costs, say 6%.
You could easily walk away with less money than your original down payment.
After owning a home for over a decade.
Precisely. You've built virtually no meaningful equity. It makes borrowers incredibly vulnerable. Any small dip in the market and suddenly you owe more than the house is worth, you're underwater.
Lenders must see that risk too.
Of course. And that feeds back into why they have to charge higher interest rates up front. The borrower's ability to build wealth is severely hampered.
Okay, let's zoom out then. The broader financial system. We kind of take the 30-year mortgage for granted as this stable, liquid investment for banks, for investors. Why does that work? And why does a 50-year term break that model?
It links directly back to that 12.3-year average ownership time. The secondary market. The big investors who buy bundles of mortgages, they rely on that predictability. They know that, statistically, most of these 30-year loans will actually be paid off in 10 to 12 years when the owner sells or refinances.
So their capital isn't locked up for the full 30 years. It comes back relatively quickly.
Exactly. It provides liquidity, stability. A 50-year loan throws a huge wrench into that. Who wants to buy an asset where the capital might be tied up for half a century? It destroys that essential liquidity.
The capital is stuck for too long. And what's this double negative for the banks themselves?
Ah, right. The bank is kind of stuck between a rock and a hard place.
How so?
Two main risks. Scenario one. Interest rates go up over those 50 years. The bank is now stuck holding this loan that's paying them a below-market rate for decades. They lose out massively on inflation, on opportunity cost.
Okay, bad for the bank.
Scenario two. Interest rates go down. What does the borrower do?
Refinance immediately.
Exactly. They refinance into a new lower-rate loan. So the bank loses that higher rate return they were counting on for the long term. Either way, rising or falling rates, the bank potentially loses.
Doesn't sound like a great proposition for them.
Not really. And that's before we even get to the legal side.
Ah, right. There's a regulatory hurdle, the qualified mortgage thing.
Yes, this is crucial. QM, or qualified mortgage. Think of it as like the government-approved gold standard for loans.
Okay.
If a loan meets QM standards, the bank gets certain legal protections if the borrower defaults. This reduces the bank's risk, which allows them to offer lower interest rates to you, the borrower.
Makes sense.
But here's the catch. By law, a loan can only qualify as a QM if its term is 30 years or less.
So a 50-year loan, by definition, cannot be a qualified mortgage.
Exactly. It's automatically a non-QM loan.
What does that mean practically?
It means all the legal liability if something goes wrong, if the borrower defaults, falls squarely back onto the bank. They lose those QM protections.
So to compensate for that massive extra risk over potentially 50 years.
They must charge significantly higher interest rates. It just reinforces why that 7% or higher rate we talked about is the realistic minimum.
Yeah.
The risk profile is just too high otherwise.
So putting it all together, the conclusion from the data seems pretty clear.
It really does.
The 50-year mortgage looks mathematically weak, offering tiny benefits for huge increases in term and risk.
Yeah, negligible affordability gain, major equity risk for the borrower.
Plus structural problems for banks and investors. And it's especially strange considering, as the research notes, the average first-time buyer is already around 40. They'd be paying until they're 90.
It really stretches the definition of long-term. It ends up looking more like a gimmick than a genuine solution. It doesn't address the real problems.
Which are?
Lack of housing inventory, high property taxes, things like that. Just making debt last longer doesn't fix the underlying issues.
Okay, so if the 50-year loan is seen as impractical, a gimmick, did the research offer any alternatives? Concrete policy ideas that would actually help with inventory and affordability?
Yes, they did focus on a few things aimed specifically at unlocking existing housing stock. Three main ideas came up.
Right. What are they?
First, tackle capital gains for home sellers. Increase the tax exclusion for married couples selling their primary residence from the current $500,000 up to $1 million.
And index it to inflation.
And index it, yes. The idea is to encourage older homeowners, who might be sitting on huge gains but don't want the tax hit, to actually sell and free up those houses.
That makes sense. Target the lock-in effect for sellers. What else?
Second, allow mortgage assumability for primary residences. Let people take their existing low mortgage rate with them when they buy a new primary home.
Oh, that's interesting. So you could sell your house, buy another, and keep your 3% rate.
Essentially, yes. It directly combats that golden handcuffs problem, where nobody wants to sell because they'd have to get a new mortgage at today's much higher rates. It would get the market moving again.
Definitely addresses the current freeze.
Yeah.
Okay, what was the third one?
The third was a more targeted tax incentive. Allow homeowners to write off up to $1.5 million in mortgage interest.
Okay.
But only for new loans taken out after a certain date, say after 2026.
So it incentivizes new building and new purchases, rather than just giving a tax break to people already locked into low rates.
Exactly. Stimulate new activity, new inventory, without subsidizing the past low-rate environment.
So those three ideas, capital gains changes, assumable mortgages, targeted interest deduction, they all seem focused on inventory and market movement.
Precisely. They address the supply side and transaction friction, unlike the 50-year loan, which just, plays with the debt duration.
Right. So for you listening, let's try to boil this down. The key takeaway from this deep dive into the research is this. That big affordability boost people imagine with a 50-year mortgage, it's largely an illusion.
Yeah.
The really powerful jump in buying power comes when you go from a 15-year to a 30-year term that gets you potentially 34% more house. But the jump from 30 years to 50 years, it's tiny, less than 8% more buying power, even in the best case scenario.
And that tiny gain comes with serious downsides.
Yeah.
Very slow equity building, maybe even losing money if you sell early, and almost certainly paying a higher interest rate.
So the math just doesn't seem to support it as a widespread solution.
And that brings up maybe a final, more provocative thought to leave you with. Think about this. The entire 30-year mortgage system we have, it only really works financially because most people don't actually keep the loan for 30 years. They sell or refi around that 12-year mark.
Right. The early payoff is built into the model's success.
Exactly. So what happens if we introduce a true 50-year commitment? What if people really did feel locked in for half a century? How would that fundamentally change the housing market?
Beyond just affordability.
Yeah, think about capital flow, the stability of that secondary mortgage market we talked about, even how wealth gets transferred between generations if homes turn over much, much slower. What are the hidden risks baked into promising these ultra-long-term rates if the expectation shifts?
Definitely something to think about next time you hear the 50-year mortgage pitched as that simple game changer. Thanks for diving in with us today.